horrible advice that almost the whole market of property investors are actually being tricked into. Literally for 10 years and generations before that, this is the myth that people believed in, that their property portfolio is going to flourish, and this is what they focused on to build their property portfolio. Now, that might have happened with your parents' generation, where in the 50s, 70s, even 80s, even in the 90s, and maybe even in the 2000s, where housing was actually affordable, where you could buy something in Sydney for less than $1 million. Now you can, but it's still way outskirts of Sydney. You're not buying retro Sydney, right? You know, when you can buy houses at $500,000, $600,000, of course that's gonna grow. But back then, your rent's also relative to it, which means that your tenant is actually helping you pay down your mortgage. Now, this was the old saying that if you need to invest in property, because if you invested in property, your tenant's going to help you pay down the mortgage. How's that going to happen? They pay rent, you pay the mortgage, and as they're paying rent, part of that rent is enough to cover the rent in terms of your interest repayments plus your mortgage repayments. Then you pay that as well. So effectively together, you help down pay the mortgage together. You pay down faster, then there's capital growth, you go again, leapfrog again, and then you buy another one. On top of that, you get this thing magically called negative gearing, which helps you to negatively gear against your taxes, so you're win-win-win. But what did they fail to tell you? That that advice worked about 20 years ago, maybe even 10, 12 years ago, but it's not working today, because your rates, your water, your strata, your insurance, your management fees, your land tax is way, way, way higher, and is eating away literally 2 to 3% of the return of your residential investments, right? So that means there's less money in your pocket. When the interest rate's at 6% or 7%, plus you got 3% of out, and you're only getting 5% or 6% gross return from your residential property, you are losing out. And negative gearing means your servicing is out the window, which means that you can't continue to buy. So it's actually a complete myth, and it's actually stopping you from growing. So we all know what keeps and grows your property portfolio is actually being able to continue to buy no matter what conditions, so you can always capitalize on what's going on in the market and pick up those deals and bargains. But if you're out of servicing, you can't do that. But also the myth that, you get relatively the same returns in residential as you have in commercial is utter fiction. Because when people say to you about residential property, you get anywhere from a 5 to 7% return, they're talking about gross returns before all the outgoings goes out. That means that all of the rates, insurance and land tax, management fees, order rates, all of those things actually get deducted out of that 5 to 7% before you pay the mortgage. Now, if 5 to 7%, you lose 3%, you're actually down from 2 to about 4% in terms of your net returns before you even hit the mortgage mark, right? And that means you're negative at least 2% to 3% depending on your mortgage. Now, my name is Helen Tarrant. I help everyday Australians become wealthy through investing in commercial property, because they can get cash flow and growth, and you can get uplift as well. But do it well, build a unicorn portfolio, hence I call the company Unikorn. And I'm here to share with the biggest myth and the biggest lies of where they tell you that you can actually win out of your residential portfolio. Let me share with you on this whiteboard how that is not the case, how when you really compare residential with commercial and you do the numbers, so many people miss out and they don't realize it's actually return on investment that matters rather than just cash flow or just growth, and that you actually lose out in commercial property versus residential property. You actually lose out in the residential property space because you lose out all the cash flow at the front end to gain the back end, right? Which is not controlled. Whereas in commercial, you don't have the same losing out as you do with residential, because what happens is that you get both cash flow and growth as well. So you get a self-sustaining portfolio that's not dependent on you. Now imagine for a moment that your portfolio doesn't need you to sustain, to grow, that you can utilize the cash flow and the growth against each other to continue growing your portfolio. It doesn't matter whether the interest rate is 7%, 3%, 2%, or 6%. Doesn't matter whether you have a 5% growth or a 10% growth. How you can balance out your portfolio where you have the ultimate control. Now that's the truth of growing wealth through property. And I'm going to share with you how you're going to do that. I'm going to also share with you right now on the whiteboard the myth that you've been conned into investing in residential, because it's literally been taught for generations and they have not changed it. Now, if this video is of interest to you, hit the bell, subscribe, and also click the link below, book in for that obligation-free strategy session where we can can utilize and show you how what I'm about to show you in the whiteboard applies to you in your everyday investment journey, but plus also join one of the largest communities in Australia of commercial property investors as well. So let's go. So I'm going to share with you now. This is the whiteboard. So we look at residential versus commercial. And it's not again about residential versus commercial, but what it is, it's about comparing what is the right returns for you, right? So when we look at this, I want you to have a look at this thing called return on investment. So return on investment, essentially what we call ROI. Now, what is ROI comprised of? It's comprised of, very simply, comprised of cash flow, so lots of dollars, and growth. And you need to look at the total, right? So let's have a look at that. So let's say this is your residential, and this is your commercial, right? Now, in commercial, typically your cash flow is the net rent. So in commercial, we have this thing called yield, right? What is a yield? A yield is the cash return on your property. So that means that if you're buying a property and the rent is 35k and you're buying the property for 500k, it's a 7% yield, right? And that's a net yield. It's a net yield where the tenant pays the outgoings on top of that. In residential, when they talk about return and they say, what returns are you getting? It's like, I'm getting a 5 to 7% return, right? That's a gross return. That's before everything, right? That's before all your outgoings and all your mortgage. Now, the yield in commercial property is the same to residential in terms of return, except that it's net. So we're looking at net. And here we're looking at gross. Net means after outgoings and before mortgage. In residential, we talk about gross, which is before everything, right? So when you compare a 7%, so when we compare a 7% here with a 7% here, they're fundamentally different. Because this 7% does not include the extra 2 to 3% that you need to pay on top of it to be able to, like you do in residential. So in residential, the 7%, there's actually 2 to 3% that comes out of it for cost. Here, your tenant pays that extra 2 to 3%, so there's more money in your pocket, right? So let's then have a look at the equation here. So with residential, with cash flow, typically when you're looking at $1 million property, right? So let's have a look at $1 million property. So let's say we're having $1 million property. If we were to buy something in Metro, say we buy something in Queensland or Victoria or any parts of Sydney, we're probably looking at about 6%. Right? 6% yield, remember, that's net. Right? That's before mortgage, after outgoings. So on $1 million, you get 60k. And it's usually plus outgoings, which is what your tenants pay, plus out and GST, right? Now, on a residential property, if you get $1 million, you're probably not going to have about $1,000 in rent. You could, but most of the time, it's probably going to be at max about $850 per week, right? So when we work out $850 per week, that works out, we times that by 52, that works out to be $44,200, right? $44,200, right? Now, remember, the outgoings are already done out of here, right? The outgoings aren't. So out of here, we have to take away our council fees, our water, our insurance, our management fees, and sometimes there's a little bit of maintenance fees, but those are the main things we need to take away from, right? So usually our management fees is probably now about 7%, 7.7%. So it's about 3,400 for the above. Now, council and water, you're probably looking at about 1,500. Insurance, maybe $1,000, right? So here we're looking at 3,400 plus 1,500 plus $1,000. So it's altogether, it's probably $5,900
in terms of you've got to take out of that 44,200. Now, if you take that away from the 44,200, and that's assuming there's no maintenance fees or anything else, is 38,300. Now here, you've got nil outgoings because your tenant pays for everything. That's insurance, paid for. Management fees, they're paid for. They pay for water, council, and any other additional fees that you might have. Like land tax. Now, I haven't even added land tax over here yet. Management, water, council, so they pay for all of that, right? So then you're netting 60K at the end of this versus 38K. 38K versus that. Now, let's say we have a mortgage, right? And for comparison's sake, I think commercial you can still get 80% LVR, so loan to valuation ratio. But for argument's sake, we're going to get 80% LVR, so that's 800K. Now, the interest rate is probably somewhere around 7% at the moment. Let's just call it 6.5% for argument's sake, because some people are getting that 6.5%. So 800K, 6.5%, that's 52K interest only. We're not talking about mortgage. We're not talking about principal and interest. We're just working on interest only. Now we have 38,000 here, 300 minus 52,000 here. We are negative. How much? So we are negative 13,700 on $1 million property, right? Now, remember we're getting 60,000 here as net rent. We minus 52,000. We're positive $8,000. So residential versus commercial comes back to the fact that we're positive $8,000. We're negative 13,700. So my question is, how is the tenant helping you pay down your mortgage when you're negative? In fact, now, if you buy a $1 or $2 million house, you're actually subsidizing your tenant's lifestyle rather than them subsidizing yours, which is what I believe any investment should be. So it's 13,700 is effectively, if you look at it over $1 million purchase, it's a 1.37%. So you're minus 1.37%. So let's go back to this graph. You're minus 1.37%, right? Commercial, you're positive, 0.8%. So not because it's 8,000, right? So it's not quite 10,000, it's not 1% yet, it's 0.8. Now, most residential, if you buy them in metro, call it metro. So metro versus metro, you would want somewhere around 8 to 10% gain. Most people are happy for a 10% gain. They would be so over the moon. Most of the time you get 5 to 8% as average, but you would be so happy to get a 10% gain. Now, in commercial, you get the same gains. Now, why? Because we're buying the same metro area. And if you look at this history of the last 3 to 4 years, we've seen property go from 40 to 60% in growth in the commercial property space. Is that going to continue? In certain areas, absolutely. Certain areas might plateau and go again. But we know that's the nature of capital growth. If you're buying the same area, let's say you're even buying the same suburb, right? If you're getting the same growth in residential, you will get the same growth in commercial, if not more, because there's more demand and less supply of commercial property stock versus residential stock. So if we look at a 10% here of growth, right? Let's have a look at what you get total as a return investment, right? When you look at a 10% here and you take out 1.37, you're actually positive 8.63 as your return on investment. So that's your return on investment. Whereas here, you're at 10.8% return on investment. In fact, you could be at 8% growth in commercial property and you would still be doing better than your residential property. But the key thing here with the commercial property is it's not a myth that you're being taught in the market like you do in residential that your tenants pay your mortgage, because you're not. You're negative 1.3. In commercial, your tenant literally is paying your mortgage, because guess what? They pay outgoings. So they pay outgoings here, and your positive $8,000, which is all going to go into the mortgage. They pay all of your interest plus the $8,000, which is going into your pockets as cash flow to support your lifestyle. Plus, you've got your growth, and it's away from you. You don't have to sustain it. You don't have to sustain it and grow it, right? So what happens in this scenario typically, where there's one of the biggest myths is that, oh, you're going to get this through negative gearing, right? So you're going to save some money. So the government might give you a proportion of that back. So the government might give you, let's say, it might give you $5,000 back in tax, right? So you're technically only negative $8,700. So it's not huge, right? Here, you might go, well, I may need to pay taxes, right? Well, depending on how you are structured, you might be structured into a company, you might structure into a trust. There's ways to minimize that tax when you're paying a little bit of tax. But even if you paid 25 cents in the dollar, which is what you do in a company, you're still better off, because even if you pay 25% tax, right, you are still better off because you're still coming ahead, right? Because let's look at it. $8,000 at, you're still $6,000 ahead, right? Now, one of the big things that I tell you is that $6,000 can contribute to your servicing, right? So this allows you, this thing called servicing allows you to finance against equity, right? Which is the growth in your property. So for example, you had a property that you bought, let's say 10 years ago, 5 years ago, even 3 years ago, that you bought, let's say for $500,000, it was worth $700,000, now worth $900,000. This $6,000 allows you to go to the bank and using the $6,000 and add it to your income. So your $16,000 is added to your income and allows you to draw down on that equity to buy properties. So it is all about being able to buy more properties. And as you buy more properties, you're able to grow. But the fundamental difference is here, the biggest myth is how negative gearing can help you grow your portfolio. How can negative 8,700 be able to help you grow? Plus, people are so focused on the growth of commercial property, they miss out on the fact that they're negative, right? With the cash flow. On top of that, their returns, when they look at it versus commercial, you actually do get better return simply because of this gross versus net. Tenant paying the outgoings versus tenant not paying the outgoings, and also rental returns. Commercial property gets higher rental returns on the same property than in residential. Plus, on top of that, what we're seeing is here is that you're actually subsidizing your tenant's lifestyle by having them having $1 million property and only clearing $38,000 versus $60,000, being negative on one end of the property, which actually stops you from moving forward, and you're actually positive in the commercial space. Now, back 10 years ago, this was very different. You could buy the same property that was probably still giving you relatively maybe $600 in rent, but the property itself was probably around $600,000. When you buy a property that is around $600,000 and you are literally buying $600,000 and you're getting $600 in rent, yes, you are breaking even. Yes, your tenant's helping you pay down the mortgage, but that's no longer the case because the value or the price of property has skyrocketed. And that's the biggest myth that we continue to believe today, where that's an outdated strategy. Now, really, the wealth is in commercial property.
Hopefully now you've enjoyed that whiteboard session where I've shared with you how the real difference is between residential and commercial property investment. How one of the biggest myths out there is that what kind of returns you get. How the returns in residential is actually gross versus net. And what exactly is gross? Gross is basically the tenant pays you one lot of money and that is everything has to come out of that, right? So they give you $1,000 for a week, and out of that comes your rates notice, out of your insurance, management fees, any maintenance, water rates, any land tax, all of those things comes out. Then you pay the mortgage, and really the rest is negative. So you have to take money out of your pockets and basically fill that pot up, or the hole up, to be able to sustain that. And ultimately you hope in about 3, 5, 7 years, there's enough growth for you to actually buy again, sell out again, and take your gains. But the thing is, if the market goes sideways, you could be losing out, or if the market tanks, you should be losing out. But of course, if the market grows exponentially, you obviously gain from it. But if you don't have servicing, which means you don't have enough income to actually pull down that equity, you lose out as well. So there's lots of losses in residential they don't teach you. Whereas here in commercial space, it's a self-sustaining portfolio. That's how I teach my clients and my students. So I run a specialist buyers agency where I help everyday Australians transition from residential to commercial. I also teach everyday Australians how to properly invest in commercial property so you don't get the wool pulled over your eyes, you do not get misled by the agents out there, and you actually buying the right properties at the right returns and at the right price. Now, the most important thing with commercial property is if you are ever negative, which you may be at this high interest rate, and you're borrowing not only the deposit from your residential property or from another property, and also the stamp duty and everything else, you might be negative $5,000 or $8,000 a year. If you were that in that case, and rarely is people in that case, but if you were, and that's if you're buying a metro property in Sydney or Melbourne, or occasionally in Brisbane industrial, but you're only $5,000 to $8,000 negative, not $25,000, but that's on $1 million property, I'm saying. But the main thing is, if you were to buy this property, then one of the big things about it, it's only going to be negative for 12 or 18 months, not forever, like residential property. Why is it 12 to 18 months? Because as the interest comes down and your rental increases go up, you actually find yourself nilling out. So if the interest rate did come down to 6%, 105% finance, which is deposit, stamp duty, everything, you will still be breaking even. No pressure on you to service the debt or the property. No pressure. Imagine that, right? Keep growing, right? No pressure. And then on top of that, if the interest rate comes down even more, so next 2 years, if it goes to 5.5% or even 3 years, you're now positive cash flow, which means that cash flow can be used towards your servicing to draw down more equity from your residential, or to draw down on the equity on the commercial you've built up, which exactly is the same as residential. If there's equity, you can draw down on it and you can go again. And when you go again, what does that mean? It means you can expand your portfolio. And having a portfolio not dependent on you means you can now be free to buy more properties, whether it's residential or commercial. You are now free to enlarge your portfolio, build and buy more, continue to buy. Therefore, you are going to create wealth faster, more cash flow, more growth, compounding, which means you get to ultimate wealth and you build your wealth much faster. So if this video is of interest to you, make sure you click the link, looking for that obligation-free session, and also join one of the largest communities here in Australia of commercial property investors. If you like the video, leave me a comment. Don't forget to click the bell, subscribe, and I'll see you in the next video.